Hey guys, welcome back. Real quick, today we're going to talk about monetary policy. Reminder, yesterday we talked about fiscal policy, the policy of Congress, spending, taxes, and the ways that we can use fiscal policy to help American workers. Today we're going to talk about monetary policy and how monetary policy could be able to assist us in this economic crisis. Monetary policy monetary policy are a set of tools that the Federal Reserve would use. Those three tools are open market operations, fractional reserve requirements, and the discount rate. The Fed, as it's known, is not controlled by the government. Really, in a way, it is controlled by the government, but not really controlled by the government. President nominates members to the board. The board has to then be approved by Congress, but it gets kind of tricky. They're not a part of the cabinet, but they're a part of the cabinet. And anyways, it gets very, very tricky, but ultimately, in theory, the Federal Reserve is not controlled by the United States government. It works closely with the United States Treasury. All right, all of our money are Federal Reserve notes. It's one way that we know that it's there, which are printed by the Treasury. Again, it gets really iffy if we say that it's not controlled by the government, but it's not controlled by the government. All right, they work very, very closely with the government, but not controlled. Those three things that we just talked about, the open market operations, the reserve requirements, and the discount rate, are the three main monetary policy tools. Now, open market operations is when the Federal Reserve is acting like a sponge. When you squeeze a sponge, right, all of the water comes out of the sponge. That water would be money. In a time of an economic crisis, the Federal Reserve might squeeze the sponge. Currently in our economy right now, the Federal Reserve is holding that sponge squeezed to keep money in our economy. Interest rates are pretty low right now, and they have remained low even with symbols of economic recovery happening in our current nation. All right. When the economy is doing too well, which is a distant memory for most of us, but when the economy is doing too well, what the Fed will do is kind of release that sponge, allowing it to pull water out of it or pull the money out of the economy. I love the sponge analogy when talking about open market operations. I think it's one of the easiest ways for us to kind of understand exactly what it is that we're talking about. Next, we're going to take a look at reserve requirements. Reserve requirements are the amount of money or assets that banks are required to have on hand at the end of the day. The Federal Reserve sets this. Now, there's a couple different ways that the Federal Reserve sets this policy. One way that the Federal Reserve sets this policy is by saying, boom, here it is. You need to have this much money. In a time of economic greatness, it'll be high. Right? We don't want the money to be flooding the economy, driving up our inflation rate, and having that happen. In a time of economic weakness, the reserve requirement might be low. Banks, lend that money out. Give that money to citizens. Let them pay you back over time. But let them have money to work with out in there, out in society, out in the world, wherever it might be. All right, so that's kind of how we use reserve requirements. Last but not least, we use the discount rate or the discount window rate. And that's the interest paid to the Federal Reserve for money that's borrowed if reserve requirements are not met by the individual banking institutions. Now, maybe they loaned out too much, maybe not enough people made a deposit that day, whatever it might be. It's usually a lot more complicated than that. But basically what you're seeing that money is borrowed and there's interest paid on it. A low interest rate means, hey, it's okay to mess up. It's okay to loan out too much money right now. A high interest rate tells you it's not okay. Make sure you meet your reserve requirement to protect our economy. Using the tools of the Fed, we can control in our economy. All right, let's move that real quick. The volume of money and credit in the United States. We can control the interest rates on long-term and short-term loans. We can, in a theory, control the employment, right, by giving out more loans for an expansion of a company. We may see more workers hired in construction. We may see more workers hired in manufacturing or whatever that company might be doing. Right? We can control output by giving, again, loans or taking away loans. You can kind of see, we can control those types of things as well as price levels. The goal, the ultimate goal of the Federal Reserve, everything that the Fed does is trying to stabilize the economy. Whether you agree with it or not, it is still just trying to stabilize the economy. At this point, we're going to cut you loose, and we got another project entry log for you guys to do, so make sure that you take some time, answer that question today in class. We'll have it back tomorrow, all right? And make sure that we're ready to go as we progress. Again, still waiting for some things to fold out, but ultimately, just know we're looking at presentations towards the end of the week, all right? Take care.